We noted that the bond market didn't move. I know that that is something that you also have and probably still focus on. It wasn't like some great fear trade where the VIX spiked and yields fell and gold went up. Bonds didn't do anything. What does that tell you?
So, yeah, this is very much an equities only story. It's not about across the board inflation fears that we've seen a lot before. This is really about economic recovery and leadership rotation, pure and simple. And when you don't see the equity markets and the bond markets in tandem, you've really got to look at what's going on and dig deeper into what the equity leadership looks like. And so when you look at the first couple months of the year and the overall trend, as well as what happened last week and certainly the beginning of Tuesday, you really see that it's the smaller cap stocks within the large cap space that are outpacing the mega caps, and mega caps have really lost their shine for the first 5 months of the year. So I think investors really need to understand that during an economic recovery with a supportive central bank, you're going to see the smaller cap spectrum outperform the mega caps, particularly when those mega caps are so highly valued for the past 2 years.
Bank of America had a note yesterday that when value begins to outperform growth, Aaron, it tends to last for a long time. I think something like 5 years. I'm going off memory, but it was around that time. The rotation into value trade has only been going on for a couple of months, but it still feels like people don't believe it. I mean, I guess maybe we've been so conditioned for a decade that tech is the only thing to invest in. You think we just can't? It's not the Journey song, Don't Stop Believing. It's never started believing.
You know, if you've been a value investor for the past 5 years, you've been underperforming. So it is hard to finally believe it. And even when you break out value versus growth year to date, we did have April where growth, it looked like growth was making a comeback, but since May, we've seen that continued value outperformance. And this relates to, again, the smaller cap, less highly valued companies. When you look at a value index versus growth, you have a bias, a big bias towards smaller cap companies within any universe. And growth tends to be those highly capped mega caps when you're looking at market weighted indices. So a value index is a way to get exposure to those smaller caps, as well as also being able to play off of any inflation concerns. So using a value ETF is a great way to get exposure to both the smaller cap recovery and economic expansion, as well as some inflation protection.
Yeah, and there's another one too, and you mentioned market weighted. And I think that's very important what you're saying, where these big tech companies, they've got outsized power in any of the market weighted index. Is that why you're recommending an equal weighted ETF? And it's RSP, I believe, is the ticker, where if a company with a $10 million market cap does well and Apple does not, the index should still outperform versus a market cap weighted ETF.
Yes, so you don't get as much exposure to your financials and some of the stocks you don't necessarily want, like your consumer staples. You do get exposed to all the companies within the broad market index, but you're definitely giving more exposure to the smaller caps, which are really what are driving the economic recovery and tend to do well for multiple months, if not a year or 2 years in an economic expansion, because they're the ones that more greatly benefit. And when you look at some of the growth rates for these smaller companies, you're looking at double-digit gains, even in the mid-20s. So even though they may be classified as value, they certainly look like growth stocks when you look at their earnings. So equal weighted is a great way to get exposure and outperform the broad market.